Before you begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Hedge fund shorts at 10-year high, retail versus Wall Street 2.0, NVDA and INTU earnings, and SPCX IPO. This video presents a direct informational narration of the source document. The structural outline for this data-driven analysis is divided into 6 segments. First, the macro environment. Second, monetary policy. Third, upcoming tech IPOs. Fourth, NVIDIA earnings. Fifth, Intuit earnings. And sixth, retail versus Wall Street.
Segment 1 covers the macro environment, focusing on the Middle East and broad market drivers.
Brent crude dropped 5% to the mid-$105 range amid reports of final-stage negotiations in the Middle East. Concurrently, increased shipping activity was noted, with 26 ships safely passing through the Strait of Hormuz. The resulting decrease in oil prices lowers inflation expectations, which mathematically supports bond prices and drives down Treasury yields.
Evaluating market sector performance, airlines emerged as the top-performing subsector in the S&P 500, driven by these lower fuel cost expectations. We observed solid, broad market gains across consumer discretionary, tech, and materials. The Russell Index led the broader market with a 2.52% surge. In contrast, energy was the worst-performing sector, recording a 2% drop in a single trading session.
Segment 2 addresses monetary policy and the Federal Reserve.
The April Federal Reserve meeting minutes reflect a hawkish stance on monetary policy. The committee expressed a specific intention to remove the term accommodative from their structural statements. The minutes explicitly noted, quote, "Majority of participants noted that if inflation continues to run above the 2% target, further tightening measures may be necessary."
Segment 3 outlines upcoming tech IPOs, specifically detailing the pipelines for SpaceX and OpenAI.
The technology IPO pipeline shows significant upcoming activity. In May 2026, SpaceX is scheduled to publicly file its S-1 registration under the ticker SPXX, targeting listings on both the NASDAQ and NASDAQ Texas exchanges. The final share quantity, price range, and total offering size remain to be determined. Additionally, OpenAI is targeting an initial public offering in September 2026.
Segment 4 breaks down NVIDIA's Q1 performance and capital return metrics.
For the first quarter, NVIDIA reported actual revenue of $81.62 billion, exceeding the Wall Street estimate of $79.19 billion. Adjusted earnings per share reached $1.87, outperforming the $1.76 estimate. The adjusted margin expanded to 75.0%, slightly above the estimated 74.5%.
During the first quarter, NVIDIA generated $46.8 billion in free cash flow. This liquidity was fundamentally driven by a 92% year-over-year growth in data center revenue.
In terms of capital returns, NVIDIA returned $20 billion to shareholders via buybacks and dividends during Q1. The board has also authorized an additional $80 billion for future share repurchases. Forward guidance projects Q2 revenue at $91 billion, plus or minus 2%, with margins expected to hold steady between 74.9% and 75.0%. This guidance explicitly excludes any forecasted revenue from the Chinese market.
Segment 5 examines Intuit earnings, analyzing their financials and internal strategic shifts.
Intuit's Q3 actual revenue was $8.56 billion, narrowly beating the Wall Street estimate of $8.54 billion. Adjusted earnings per share came in at $12.80, above the $12.57 estimate. However, year-over-year revenue growth decelerated to 10%, down from the 15% growth rate recorded in the prior period.
Despite the growth deceleration, Intuit raised its fiscal year 2026 EPS outlook to a range of $23.80 to $23.85 and raised its revenue outlook to between $21.3 billion and $21.4 billion. Concurrently, the company is executing a 17% workforce reduction. On the technology front, Intuit is integrating OpenAI and Anthropic Claude models into its software. However, the data confirms that this AI integration is not yet driving significant top-line revenue growth.
Following the earnings report, the stock experienced a drop to the $330 range. Despite this, analyst consensus remains structurally positive. Among 33 institutional analysts, 84.8% maintain a buy rating, 15.2% maintain a hold rating, and there are 0 sell ratings.
The average price target stands at $593.65.
The final segment addresses retail versus Wall Street, focusing on current market psychology and leverage dynamics.
Trading behavior within the semiconductor sector currently displays significant polarization. Retail investors are aggressively opening long positions through call options and highly leveraged ETFs, such as SOXL. Conversely, institutional hedge funds are cautiously trimming crowded long positions while aggressively increasing their short positions to a 10-year high.
Analyzing the underlying institutional leverage metrics, total hedge fund leverage is currently at a 5-year high. However, net long to short exposure remains relatively mild. This specific divergence mathematically indicates that extreme leverage is being applied specifically to short positions. The recorded data directly mirrors the setup observed prior to the 2021 market squeeze.
This current structural setup, characterized by aggressive leveraged retail buying colliding with record-high leveraged institutional shorting, aligns precisely with the conditions seen prior to the 2021 Melvin Capital short squeeze dynamics. Based on these metrics, the final question presented by the data is, are we witnessing a repeat of the 2021 institutional short squeeze?